Welcome aboard, my savvy sailors. Today we're on a mission to navigate the choppy waters of retirement income and avoid the dreaded tax torpedo. What's that, you ask? Well, it's not a literal torpedo, but trust me, it can blow a hole right through your retirement plans if you're not careful. This baby shows up when your income starts triggering unexpected taxes on your Social Security benefits. It's sneaky, it's costly, and it's about as welcome as a seagull at a picnic. But fear not. By the end of this journey, you'll know how to steer clear of its path and keep your retirement ship sailing smoothly. All right, let's break this down. Imagine you're retired thinking life is great until Uncle Sam sneaks up and says, "Hey, remember that Social Security you paid into for decades? Surprise, you might owe taxes on it." Here's how it works. The IRS uses something called your combined income to determine if your Social Security benefits are taxable. Combined income is the sum of three things: your adjusted gross income, AGI, half of your Social Security benefits, and any tax-exempt interest like income from municipal bonds. If your combined income exceeds certain thresholds, up to 85% of your Social Security benefits could become taxable. And when that happens, the tax torpedo strikes. For single filers, the torpedo starts creeping in at $25,000 and fully hits at $34,000. For married couples filing jointly, it's $32,000 and $44,000. Sound low? That's because it is. Let's say you're pulling in income from a variety of sources: a pension, withdrawals from an IRA, maybe some dividends. Every additional dollar of income can push more of your Social Security into the taxable range. It's like a domino effect. Earn a little more and suddenly a whole lot more gets taxed. Boom! The tax torpedo has struck. $1 over the threshold can lead to up to 85 cents of additional taxable income. It's like stepping on a rake. You don't see it coming, but you feel it. Now, if you're thinking, well, I guess I just won't make any money in retirement, hang tight. I've got better solutions. All right, let's get into the good stuff. How to avoid, or at least minimize, this pesky torpedo. Here are 5 strategies to keep it at bay. Spread out taxable withdrawals. Don't take huge lump sums from your tax-deferred accounts like traditional IRAs or 401(k)s in a single year. That's like poking the torpedo with a stick. It's going to blow up. Instead, spread out your withdrawals over multiple years to keep your income below those dangerous thresholds. Think of it like eating a giant pizza. Don't scarf it all at once. Take a slice now, a slice later, and save some for breakfast. Leverage Roth accounts. Roth IRAs and Roth 401(k)s are your best friends here. Withdrawals from Roth accounts don't count toward your combined income. So if you've been diligently converting to a Roth IRA or contributing to one, now's the time to enjoy the fruits of your tax-free labor. Roth withdrawals are like a stealth submarine, completely invisible to the tax torpedo. Delay Social Security benefits. The longer you wait to take Social Security, the higher your monthly benefit will be. And while that doesn't reduce your combined income, it gives you more time to use other income sources first, like your tax-deferred accounts at lower tax rates. Waiting to take Social Security is like letting your wine age. It gets better with time and you enjoy it even more. Manage your tax-exempt income. Remember, even tax-exempt income from things like municipal bonds gets included in your combined income calculation. If you're close to the thresholds, consider reducing your exposure to these types of investments. Tax-free doesn't always mean torpedo-free. Uncle Sam plays chess, not checkers. Use qualified charitable distributions, QCDs. If you're 70 and a half or older, you can make qualified charitable distributions directly from your IRA to a charity. These don't count toward your AGI and can satisfy your required minimum distributions, RMDs. It's like donating to a good cause while dodging the torpedo. Give a little, save a lot. Charity for the win. Let's look at a real-life scenario to see how these strategies work. The Smiths are retired, married, and filing jointly. They have $20,000 from Social Security, $25,000 from a traditional IRA, and $5,000 in tax-exempt bond income. Their combined income is $42,500. Boom, tax torpedo territory. Up to 50% of their Social Security benefits are taxable. But if they use a Roth IRA for part of their income, reduce their bond income, and stagger their IRA withdrawals, they could bring their combined income down to $30,000. No torpedo, no problem. Now let's talk about what not to do when trying to avoid the tax torpedo. Ignoring the impact of RMDs. Once you hit 73, RMDs can send your income skyrocketing. Don't wait until then to plan your strategy. Making huge Roth conversions all at once. Roth conversions are great, but if you convert too much in 1 year, you'll trigger the torpedo anyway. Convert gradually to stay safe, focusing only on taxes. Don't let the fear of taxes lead you to make bad financial decisions. Sometimes paying a little tax now saves you more in the long run. The tax torpedo is a sneaky little devil, but with smart planning you can avoid its wrath. Remember, it's all about balance, managing your income, timing your withdrawals, and using tax-efficient strategies like Roth accounts and QCDs. Now that you know how to dodge the tax torpedo, go out there and enjoy smooth sailing into retirement. And if you need help navigating, call a financial advisor, your personal retirement GPS. Thanks for watching, folks. If you found this helpful, hit that like button, subscribe, and share with a friend who could use some financial bumper lanes. It will help us create more fun and helpful videos like this. See you next time.